Good afternoon, everybody. Michael Silva here. You're watching the Stock Market Brief Show. Yesterday, we were discussing how volatility increased from that weekly expected move, and that's a very rare thing to take place. So I want to dive into that today again and show you how that changed, what happened. Right here is a chart of the Qs, and we gave out the daily expected move, and we did a round trip here coming down to the lower zone all the way to the higher and then ranking right back to that lower weekly implied move, which we had discussed. It's very common to see this type of behavior. But now we got some stuff that could potentially happen to send this market even further. All that and more on today's Stock Market Brief Show. If you haven't subscribed, please do so. Thumbs up, comment. That's what helps my channel grow, along with my partners that keep me doing this, Interactive Brokers. Check out the link there in the pinned comment. They have a great platform. I trade on Interactive Brokers. I have Fidelity too as well, but I definitely use Interactive Brokers for most of my trading stuff, shorter term stuff. They have a campus there, and the campus offers a bunch of free resources and tools. They got webinars, they got podcasts, they got all kinds of stuff. And then a big thanks to my Patreon group. Hope you're enjoying those new daily moves that we've been posting there for the last couple of days. For those that don't know, I'm going to share the SPY's Qs, and once again, I'm going to share the Mag 7 plus MicroStrategy because I was asked about it. Expect to move today in that section. Let's get into today's show. All right, ladies and gentlemen. So I want to start off with this news that dropped. There was an interview by Howard Lutnick, and in short, the news that basically came from this was more about tariffs and how tomorrow we could potentially be seeing some sort of resolution. So if you haven't seen that interview, he posted it on his own Twitter there, but it was on CNBC. But the reason why I find this to be important is not from what he says and what the narrative is, it's what's the market doing. So I wanted to bring up a chart of the dollar and show you just how big of a hit it took these last couple of trading sessions, including today. So there's a big drop off from the dollar. Now, this to me is important. Why? Because when we were in October, going into the election and going into the inauguration, the dollar was ramping up higher. And if you remember, we were talking about how the market, how the dollar was pricing in the potential for tariffs. So now that we're getting the ideal news hit the tape, sort of more tariff ordeals, deals being negotiated, but potentially a resolution to come tomorrow, and the dollar's falling off, is this the market basically getting ready for that to come? And I think that that's a possibility, but it's not only the dollar that took that hit today, but TLT, right? The bond market, look at yields, what they did. And then look how we have this flight to safety this year, and all of a sudden the market starts to turn around when we get some of this news about a potential resolution tomorrow. Now, if you look at the 11 sectors that make up the S&P 500, everything was in the red today. Financials got clobbered at 3.52%. Dow Jones finished down over 600 points. S&P 500 was down 1.2%. Over here, I have some of those various sectors, but I wanted to call out, look at semiconductors. Semiconductors creeped up from being down quite a bit to up 1%. And then quantum ETF, QTUM, was up a half basis point. And this blows my mind. ARC Innovations ETF was down about 6% intraday, and it finished green on the trading session. So very, very wild price action overall. Did we move into a full-blown capitulation? It's getting closer. It's not exactly what I like to see for a full capitulatory move, but we had a lot more red on this screen, and then we finished with even more red. You can see over here, if we look at the S&P 100, yesterday we shared this, and we're about 65 declining stocks. Well, today we finished down with 85 to 16. So this looks to be more capitulatory, and this is happening when our VIX futures curves went into backwardation. So these are all things that we've been kind of planning for and waiting to see to feel more confident that we can potentially get that market bounce or that bear trap type of bounce. Whether that leads into just a dead cat bounce, I don't know yet. But that is what's currently going on here in this environment. If we take a look at back month versus front month, this thing is sunk down past that 1.0 level. And this is where you can typically see the market try to pick its head off the mat and stand on its feet a little bit over here. So that's kind of where we're at. Now this is where it gets crazy, okay? So yesterday we talked about how the implied moves kind of expanded, right? Even though for the weekly expected move, it went bigger despite even already having a full day of trade. Well, take a look now. This is interesting. So the daily implied move for tomorrow, this is why I think things are going to get a little crazy, is because the S&P 500 is putting in a plus or minus $7 move. Now, for those that don't know, right, $7 moves for a daily expected move is crazy. You can sometimes see this for the week, right, in the S&P 500. So tomorrow it's $7. Yesterday or for today, right, it was $6.39. The day prior was $5.61. The day prior before that was $5.93. The one before that, which was February 27th, was $6.21. So this is one of the bigger daily implied moves that I've seen for quite some time. And then take a look down here. This is for the remaining of the week. We have 3 days left, $11.83. Let me remind you, this is a little bit less than what we've seen from the start of the week, but we've now had 2 trading days with massive moves, and the expected move for the remaining of the week still is above $10, above $100 in the SPX. All this means, people, all this means is you better sit on your hands. And if you're being tactical, be very tactical. But if it goes against you, just don't fight it, because this is where you can get some wild two-sided trade that can lop you back and forth. Okay. And I think we've been saying that, and we've saw that today legitimately take place. Okay. Take a look here at the weekly chart. The weekly chart, that's one gigantic candle. We're down almost 3% on the trading week. This is where we can see those rubber band type effects where you get extended from the weekly 5 EMA and then all of a sudden you see a snapback. We saw it here, right? And then boom, we saw it even over here. And then boom, snap to the downside. Right here, boom, snap back to the downside. We got extended here, boom, snap to the upside. So remember, just because we bounce does not mean anything, right? We're in an environment, and I'm going to tell you how we can articulate this to feel more confident, but just be aware that if you see a bounce, just like we did today, how the market went from pretty darn red to green, back to red, you need to be aware of how the market conditions are, because this is normal in these conditions. And I'll go over that, okay? If you zoom out and look at the weekly time frame, this divergence is actually playing out over here. We've saw a bunch of negative divergences on the RSI and the MACD over here from a weekly basis, basically where price action goes higher. You get a diverging reading on these indicators. You got bullish one over here that led to a rally. And now we have this playing off to the downside where the RSI slipped under 50. We haven't actually had a slip under 50 for quite some time. It was more back over in this range where we slipped a little bit lower, undercut the 40-week moving average, which is roughly the 200-day moving average. And you can see we came into that almost today. We almost tagged the 200-day moving average. Last year, I don't even think we touched it. No, we did not touch it last year. It's typical to touch it, but we got close there. Okay, so is this playing out to something bigger? Hey, potentially, right? But like I said, if we bounce, it could always be a higher low, and we could see these internals still continue to weaken. Now, when we take a look at seasonality, this was posted by Jeffrey Hirsch from Stock Almanac. I like his seasonality charts. He incorporates a little bit more data than the one that I have been showing. This one's going from 1949 to 1924, and it's versing the 2025. So the red line is 2025. And then the purple line is basically taking the data of all the incumbent party losses and what that seasonality looks like. Then it has all post-election year seasonality, which is in black. And then you have the aggregate cycle over here too as well. And basically what we're seeing here as we're coming into March, we're nearing the area where we start to find a bottom from a seasonality perspective. Now, can you trade based off of seasonality? Can you be 100% accurate? To an extent, maybe, yeah, you can add it to your bucket list. But for this to be the only thing that you use, it could be very, very difficult because we don't always match up to seasonality. So it's one of those things that you can just have in your back pocket. Now, if we take a look at, I think this is just the last 5 years of seasonality, so it looks a lot more extravagant because COVID kind of falls within this time frame over here. And you can see that we're about halfway through of most of this seasonal weakness. So is this just a seasonal blip? Is it something bigger? I'll tell you what, you look outside to X and everywhere else, and it seems like there's something much bigger going on. But right now, it's kind of following that seasonal trajectory, so we got to just continue to monitor it the best that we can. Let's take a look at some of the signal charts, and what are these telling us? This will tell us oversold, overbought, positive divergences, negative divergences will give over breadth and so forth. So we'll look at some bullish percent charts. We talked about this one yesterday, the NASDAQ composite for the bullish percent index. This one actually did come off further, so we still have that positive divergence. RSI is getting a little bit oversold. The NYSE over here is just put in its positive divergence, meaning that we got a lower reading, which is different from yesterday, and we still have a positive divergence forming there on this RSI. The discretionary sector moved into oversold conditions. The RSI did, that is. The technology sector finally came off a little bit more here too. RSI is in those oversold conditions there as well. And you can see we've done this many times throughout history where you get oversold and you could sometimes see bottoms and bases. Now remember, oversold can stay oversold. So it's always nice to see these positive divergences kind of form. And that gives me like a little bit more inclination to feel more confident of a bounce. But we'll see what happens here in the near future with this. So that was the technology sector. If we look at the percent of stocks above the 200-day moving average and the 50-day moving average, for the NASDAQ 100, these lines came off quite a bit actually. So take a look here. We actually haven't really been to these low levels since, well, August really of last year. So as the NASDAQ 100 has been coming off, we finally seen this, the percent of stocks above the 200-day coming off too as well. So we're getting about a 52% reading right there. 50-day moving average, you can see that we're actually a lot lower a little bit earlier here. That was in 2025. And right now we're at about 43% of stocks are above that 50-day moving average. If you look at the S&P 500, the percent of stocks above the 200-day moving average are coming back to and around the early 2025 reading. And these are relatively low readings comparatively when you look back, which is kind of interesting because you have less and less stocks, right? Less and less stocks, that's what this line is telling us, that are above their 200-day moving average, but yet the market's been kind of going higher, and then all of a sudden it's starting to stall out here, right? It's like basically saying, hey, all of us are getting weak, there's only a few stocks holding us up, and eventually we're going to have to resolve ourselves in some sort of way. So that's what we're seeing right now. It's getting to a pretty low reading, about 50%. That's a pretty decent reading there. And then you take a look over here. And by the way, that's not really capitulatory by any means. Like right over here, when we went through our 10% correction, this thing got down to 30%. So there are lower readings. And then the same thing with the 50-day moving average. The percent of stocks above the 20-day moving average, this is starting to come off a little bit more. Still not, it's not still entirely in oversold conditions, but now we're actually reaching those levels. You can see this in the small caps over here. It's getting down to those levels that gets a little bit frothy to the downside. The mid caps, the 1500s, it's creeping there. We got the NASDAQ composite reaching into that territory. By the way, I don't have the chart, but I showed new lows. That thing blew off pretty high, so that thing got to like a 600 reading versus yesterday, which was 400. So that thing started to move too. I found this interesting about small caps. So I pulled up the IWM today on the live stream, and basically what I'm showing here is a couple of lines on my chart. So this just right here is IWM with the 50 period, right? 50 period EMA. Down here is the price percent oscillator, but I'm changing the settings. So basically what I'm doing here is there's a zero line right here, and then it goes positive up here and it goes negative. And then the line is telling you the percent that the price action of IWM is away from its 50-day moving average. So for example, if you just look at where we are now and the IWM is down here, and see how the 50 period EMA is up here, so there's a pretty big disconnect. Well, this is what it looks like charted out. So you can see this intraday, by the way, intraday, we were reaching down to like minus 8% when we called it out on stream. And we're like, wow, that's pretty extended there. So right now we close at about minus 7%. So we're about 7% away from that. So a lot of the times it can get back to zero or reclaim it. That's typically what it does. It goes very oversold, overbought conditions. And even if price action goes sideways, right, this thing will go down, which means this line would go up. But if you look, you can see like the last time we were at these readings was October to November of this year. And that came down to this low in IWM. And we saw the market bounce from those levels. Right over here, when we got to about a minus 8% reading, you can see that we try to find some sort of bottom when we bounce. Over here, we extended through it. Over here, we extended through it. Over here, we extended through it. And we saw bounces from these levels in and around these areas here when we get these big readings. So is it possible to see a bounce in these small caps here in the near future? I think so. And I think that goes still to that whole point that I've been trying to say about there's potentially some good small cap setups kind of like midway through March. We'll see, right? There's another chart been wanting to share, but I'm going to save that for another market brief. Let's continue on. We'll look at the conditions of the current market. Remember, I look at two things for the current conditions of the market. That's the gamma flip line and the direction of the 5-day moving average. So we'll start with the gamma flip line. We're still below it, right? When we're below it, we get selling into selling, we get buying into buying, volatility increases, right? Liquidity, it dries up. And that's what we're seeing. That's what we've been seeing. It's now 6 or 7 days in the flip line, under the flip line. So right now that's roughly at about 6,000, still a little bit higher. And we've undercut that 5,800. We made a big move back, but that thing got pushed right back down to 5,775 today. That's the SPX, that is. And this 5,775 actually was a key level in the early trading session today, where we kind of kept our eyes on throughout the entire stream, basically saying that, hey, even if we start moving up, right, it's possible to see this thing pull back into 57.75 because it was such a concentrated level from a 0-date perspective. So in the Discord, I'll be updating that into tomorrow's trading session. I might post it on Twitter too if you follow me there on X, okay? So negative gamma, right? So this means already a more volatile market environment. That's what you need to be aware of. As far as the 5-day moving average goes, we're declining across the SPY, the Qs, IWM, DIA, XBI, and semiconductors. So once again, if you want to be patient in this time and you want the market to prove itself and you don't want to prove to the market how smart you are, right? You need to wait and see what the market does and try to recover this 5-day moving average and for it to turn back up. That's step one. And then you really want to see the market back in positive gamma, because that can give you more an inclination that volatility is going to subside and you can put more capital to work, and you could potentially be moving into the next leg higher in the market or a potential shorter term trend to the upside. But right now, what do you see in the SPY? Well, you've seen basically, it started declining over here on the 21st of February. You see a sell-off, you see a pullback, but it's still below declining 5-day moving average. It pushes, it pulls back, it pushes, it pulls back, it pushes, and it pulled back again, and then push. So what are we seeing? We're still seeing a series of lower highs below a declining 5-day moving average, and all these products here are below their year-to-date average. So I know that people want to try to catch bottoms, but here's the problem. The market hasn't proved itself yet. You would be trying to prove the market correct. And this game of trading, swing trading, more specifically, if you want to be consistent over the long term, you need to be on the right side of trade, right? You need to be on the right side of trade, the easier side, and the easiest side is to be on the right side of the trend. And right now, if you're fighting the trend, you're dealing with this volatility, you're getting chopped up, and that's the unfortunate thing. But if you are a tactical day trader, from a more intraday perspective, this is the conditions that work much better for you. Below flip lines, right? Below a gamma flip line, you could be below a declining 5-day moving average, or it can be flat at that point. But technically, traders like volatility, two-sided trade, and that's where we're at. That's what we're doing right now. Now, I want to also add another element here for people that are trying to be more patient and add more exposure. I made a video a while ago called "Finding Stock Market Bottoms" and how to spot basically every start of the bull market. And this is a video I put together back in August of just 2023, when the market sold off very, very hard. And the reason why I did this was because this would add another element to these market conditions, right? It was talking about the work and the research from William M. O'Neill. And I find it to be very important that if you haven't seen the video, this was an underviewed video but it was very critical too, if you're really trying to get back into the market and feel more confident, and you're using specific signals that have a historic track record for finding bottoms. And that's what this video is. And we'll talk about it more when the time comes, which could be very soon. And I'll dive into it about attempted rallies, about follow-through days, and etc. So I use this all the time when we go through market corrections. Let's talk about expected moves. So yeah, the Qs danced around their expected moves today. I'm going to give you the update. And I also shared the Mag 7 expected moves. So NVIDIA came down to its lower, it round tripped all the way to its upper expected move. These are levels that I put together using mathematics, right? And I'm not a mathematician by any means, right? So I come up with the kind of a formula, and then I get some feedback on it. And I finally figured something out that really does work based off of the individual assets volatility. This was today. This is a level that I shared with you on yesterday's brief. You can go back on my Twitter. I posted every single chart that I shared of how they kind of interacted at these specific levels. So for the next few days, new videos, I'm going to be sharing these Mag 7 levels with you, and then it's going to be just there in the Discord group. Okay, take a look at the SPY for the 15-minute time frame. We're looking at roughly about a $7 expected move, $7.10, which is huge by huge. So right now we're outside of the lower weekly implied move. If we were to crack down to the lower daily, there's a lot of confluence down here. But what I mean by that is this is also what the month priced in for expectation. So if we actually do come down a little bit further, we would be, let's just say it happens this week. That means on the first week of this month, we've already reached down to what the market anticipated for the risk for the entire month, which is pretty big stuff. So we'll talk about that if that happens. Other than that, we are below the weekly implied move. So if we start moving up higher, right? If we start moving up higher into these levels, these are the areas of confluence to watch. The daily, which is about I'm just going to round it to 584 to 585. And then also that's just under the last year's closing price, the gray shaded area. So if we were to move $7 higher tomorrow, which is a big move, where would that put us in terms of the gamma flip line and the 5-day moving average? It'd still put us below a declining 5-day moving average and in negative gamma. Okay, so when we're in these conditions, we can see big rip your face off rallies. They can be faded. You goes both directions. So just be aware of that a $7 move to the upside tomorrow, and maybe more, right? If we do get that tariff resolution and the market likes what it sees, that is, it could be even more than that, right? You can look into 2 standard deviation moves. It's too hard to kind of guesswork this, but this is always a possibility. So when the market starts to recover, right, that could be the sign that we can start adding more in or feeling a little bit more confident that these conditions are going to start to change. If we take a look at the Qs is pricing in a $7.60 expected move. We got outside the weekly implied move. We came back up today. Everything was all gravy and golden and everybody loved it. And then the last 30 minutes of the trading session, we just wiped it all away. Boom. Where did we wipe it to? The weekly expected move. So we're just right back down there. Now in yesterday's video, like we said, it's very common to see this type of behavior. So just be aware of that. Tomorrow, we have about a daily implied move about 488 to the downside and about 503 plus to the upside. Where would that take us? That would still be down on the year, and that would be below a declining 5-day moving average. So it's still going to take some time to recover all of this stuff. This right here is the expected moves for the Mag 7 plus micro strategy for Moonraker down there. Okay, you have your upper levels, and then I even included the 2 sigma levels over here, which just means a 2 standard deviation move. Sometimes that happens. Actually, in fact, I think Meta, if I can't remember exactly which one, but I think it was Meta that actually hit that 2 standard deviation level or came very, very close to it, and then started moving from it. That's all I got for you on today's episode, everybody. Hope it helps out, gives you some insight. I'll see you later.